Since the financial crisis, central banks around the world have printed $20 trillion worth of fiat currency that they're willing to admit. They have cut interest rates 800 times. They have promised to make their currencies confetti if required in order to maintain order in the financial system. All of this has been at the expense of the average person. They're pulling in an all-nighter, foregoing another night of sleep, taking back another big dose of caffeine instead of giving it a break, a chance to breathe. But of course, it must always go out in style, always in a spectacle. Here we go. You came here for the truth, so let me unveil that for you. Today we're going to look at a jam-packed episode filled with data. I've got charts, I've got articles, I've got quotes from some of the big names out there. You are not going to want to miss this one. It's going to be huge. Let's get into it right away. I wanted to start with the balance sheet of the Federal Reserve. You know how I like to show you this repeatedly over and over again so we can track and trace what has been happening. And you can see for yourself that we are now at the highest level the Federal Reserve balance sheet has been at since they started to decelerate their purchases. And you will see here that we are at just closing in on 4.2 trillion. It started to look like maybe, just maybe, they weren't going to increase their balance sheet because it was moving up and down in this range for a few weeks. But of course, it seems like they've gone beyond that. It all depends on the maturity of their current so-called assets, what's happening there. But the trend since September has definitely been up. So that's the progress report on that. I don't want to harp on it too much. You could see Northman Trader, what he had to say. The Federal Reserve is a mere $23 billion away from an all-time high in treasury holdings. So if we look at this specifically for the treasuries, they're almost there. And of course, they will increase the amount that they have. They need to do this. They are talking specifically about how they are engaging in that on a daily basis. They want to be able to accelerate their purchases, and that is very important to the markets in general, that they are the ones buying up this debt that nobody wants. They're also buying the mortgage-backed securities as well. We know what they're doing with the repo operations. They want their hand in everything, and in the next crisis, I suppose, maybe, just maybe, they'll actually buy shares of the stock market. Let's see what happens with that. I'm not much for speculation, but it seems like it could be likely. I'm going to show you a few charts here. This is the first one. Biggest ever week of bond fund inflows, and it might be hard to see on your screen, but what we are looking at right now, 2019 into 2020, clearly there has been this surge of money going everywhere. But in this chart specifically, we are watching the money flowing into bonds. Now, why would it be going into bonds at a time in which stocks are doing so well? Doesn't it seem unusual to you that you've got approximately $13 trillion of negative yielding bonds globally, and yet the money keeps flowing in? It's incredible to me to see something like this, to see an Argentina bond that's 100 years that was oversubscribed. You're looking at all kinds of things that are messed up right now. When the Greek debt 10-year, I believe I just showed you yesterday, is going at 1%. So you are potentially taking a big risk here, and what's your reward? Not much, that's for sure. As you can see, the disruptors is what they call them. Essentially, we're looking at the tech stocks, the FANG stocks. These are the ones that have done incredibly well over this period of time. But we have seen something that we hadn't seen in the previous bull markets, and that is the stock buybacks. Stock buybacks have been at a rate it has never been before, not even close. We can't even compare them in previous cycles because it is so astronomical. And why? Because we have debt that is so cheap. I've shown you that over and over again. I just wanted to show you the comparisons in the previous bubbles and what has happened. We had, of course, the housing bubble and the commodities and everything else previous, but we are watching the biggest bubble ever in history today. People need to acknowledge that. Technology is the least regulated U.S. sector. And of course, the more regulation they'll put in, I think this could have a dramatic impact on what we see at these particular companies. When you look at manufacturing, all the jobs seem to be going overseas for manufacturing. Too many regulations, not so good for business. What will happen with tech? Will that situation start to move over the next few decades? I'm interested to see where it all, how it all unfolds. This is just showing you some data comparing the different industries. Record annualized inflows into bond and equity funds. You could see the yellow line, that's bonds, the blue is equities, and although it's an annualized number, if it were to be anywhere near this, it would be huge, huge, huge. We could see that equities were down for the year 2019. A lot of people don't believe that. A lot of people still today, even though we're in 2020, looking back on 2019, the data is all there, it's available to everybody. You can check with the EPFR if you need to. It's all there showing us where the money is going to and from, and equities actually saw a decline, a contraction. How could that possibly be if we have the stock markets rising? Well, of course, GPS, you're so bearish, you're so ridiculous. But what's ridiculous is the people who do not understand what stock buybacks are. They don't understand it other than the fact that this is good for their portfolio. That's right, but whatever, doesn't matter to me. Now this year things have changed because risk is on the table. We have watched a huge change in what has happened with the Federal Reserve from 2019 into 2020. So the money is flowing in now. It's flowing in on the retail side as well, which is much different than what we saw back in 2019. We are seeing this going on at a time in which people should be more cautious, and we'll talk more about that in a second. Bank of America private clients keep selling equity strength. So you are watching in this particular case here, equity happens to be the yellow bar, minus 1.8% for 2020. This is annualized data again. I'm interested to see what happens. I don't think it will always be the case going through the months. We're still extremely early in the year, but this is what we have so far. There's a lot on the screen right now. I realize that. I'm not going to read you the whole thing, but this is from Guggenheim. And on this post that they made, that I think people should read, it's really good, talking about the situation that's going on in China. And I wanted to also look at what he said here. For those investors who perceive the disconnect between risk assets which are priced for a rosy outcome and the reality of the looming risks to growth and earnings, any attempt to reduce risk leads to underperformance. That's why we're in a crazy environment today. He gets into that further. I just want to touch on a couple points though. The frantic race to accumulate securities has cast price discovery to the side. The giant flood of liquidity is driven by virtually every central bank in the world injecting reserves into the system. Many investors today don't even buy individual bonds. They purchase a basket of bonds that can be traded versus an ETF. The quality of the bond doesn't matter. No one is actually negotiating a rate or a price. This is when you know everything is broken today. Nothing makes any sense because all of the ways that were being done just a few years ago are suddenly not good enough. This will eventually end badly. I have never in my career seen anything as crazy as what's going on now. It was crazy in 2006 when I was pounding the table saying that we were going to have a financial crisis of biblical proportions. And it was crazy in 1997 when high yield spreads got as tight as 239 basis points over treasuries in October of that year. And he goes on. This is what we're dealing with right now, that people are starting to ask questions. They're starting to become a little bit weary of what we are seeing. And these are billion-dollar companies. We're not talking about some random writer on Seeking Alpha. This is not what this is about. This person here is the former GM, Ford and Chrysler executive, and Goldman Sachs analysts were asking him if he has any idea what the heck is going on. That's a quote. Nobody can explain it. It's driven purely by psychology or almost a mass psychosis. Right at the bottom here, ultimately the share price responds to financial fundamental reality and that day will come. Of course, he's speaking about Tesla, but the situation really applies to everything we're seeing today. There's so much that's out of whack and there's no real explanation for it except for this. 800 rate cuts on and investors throw money at everything. This is according to Bank of America. Investors poured money into most asset classes last week, with bond funds attracting $23 billion and equities and emerging markets benefiting too. They noted the high levels of cheap money available after the 800 rate cuts worldwide worldwide since the financial crisis. Bond funds saw their biggest weekly inflows ever, while equity funds pulled in $12 billion in the week. I like the word that they used here. They are irrationally bullish. It's almost as if they don't want to be bullish, but at this point, stocks continue to go higher. The money is so cheap right now today, and so why in the world wouldn't they want to invest to get that yield, to get this for their clients and potentially themselves? Everybody is following in line, and that is actually quite unfortunate the way it's all worked out. This is another article out of Market Watch talking about, the insanity that we're seeing in the markets today. These monetary distortions, a word that I like to use often, lead to this reckless reach for yields that we are all seeing randomly. Go look at a screen and it's pretty crazy. Big caps, small caps, credit markets, volatility, it's crazy. Reach for yield is everywhere. They will never be able to normalize rates in our lifetime. Recessions and stock market crashes really have been instigated or started by central banks sort of pulling away the punch bowl. I would disagree with that. They raise rates, and that has led to a slowdown and ultimately has led to these crashes that we see. They realize that the global economies are in a situation now where the banks can't pull away, and they're bluffing if they say they can. Now, I want to go back just a moment ago why I was saying that this isn't true. The rates are kept artificially low. So if you see what's happened with interest rates, basically they've been brought to the floor, but they've been held down. And that's been held down by the money printing, by the quantitative easing. If that quantitative easing was there, the market would actually find interest rates to be higher. What's the actual percentage? Well, it depends on which country, and I'm sure the more granular you would get that, for example, if each state had their own interest rates, if there was a way to find price discovery in all different methods, all different areas, there would be different interest rates all over the place. But with the Federal Reserve centrally planning what we have in the financial system, you got it all messed up. Look at what's going on with the EU. They can't figure out left from right. There's a big mess going on over there, and why? We got the ECB trying to figure out an interest rate that is applicable to all of these different countries with completely different situations. You got Germany, you got France, you've got Italy, you've got Spain. They're all using the same interest rate, same currency. That doesn't make sense. So you see, all I'm trying to say here is that the central banks created this territory that we found ourselves in. They've created this mess, okay? And that is not going to be resolved by what the central banks are planning on doing. It doesn't work like that. It never has, and yet we have to see this all the time. I found this really interesting. I'm going to quickly show it to you. When we're looking at the green line here, that's the repos. And of course, we saw, if you can see it on the chart, basically we're looking at this huge spike up. I've been covering it here before. And all throughout this period of time, since the financial crisis up until that moment in September where they decided to bring this out, they had no repos going on. They weren't using that at all. But I just wanted to clarify something here because we saw it at a low level throughout the 2000s. Nothing really went up or down or whatever, but just before the financial crisis was really getting hot and heavy, we saw this spike up. There was a big need for that. They provided liquidity to the system, but as soon as QE1 started, they simply got rid of all of these repos. They didn't need it anymore. You were buying up a whole bunch of garbage. Now, although we have QE4 today, is it possible that maybe the repos will go away? They can bring that to zero, but once they get to that point of zero, that they will bring in an official QE4, or maybe we'll call it QE5, who knows, whatever you want to call it, doesn't really matter. I call it Susie, but is that a possibility yet again? Or will they be doing both? Will they really expand both? Where they'll keep the repos going at a low level for an indefinite period and then decide to bring in another round of quantitative easing? I'm not sure. We'll have to see. That's all for this video. If you found that informative, hit that thumbs up button. Don't forget to hit the like button before you leave. That's all I ask. If you watch the advertisements before the video begins, that is really helpful to me as well. Thank you very much. If you want to learn about e-commerce, if you want to sell on Amazon, but you didn't want to pay $1,000, $2,000 for a course, I created one for free for you, my subscriber, the AmazonGPS.com. If you want to learn about the financial history and why we are headed right back into the same situation we have encountered over and over again, these two books are going to explain that for you. Check it out at the link in the description. If you want the audiobook instead, themoneygps.com. Well, now, don't go anywhere because this video has it all. Top to bottom, you're going to get so much data, jam-packed. Check it out. See you there.